Hello, dear investor. You remember after the Corona crash, some tech stocks were completely hyped, overhyped, had price earnings multiples, three single digit range, 100, 200 and even more. And afterwards, or today, most of these tech stocks are forgotten. And we often favor other stocks right now, like solid dividend stocks. But anyway, some of these companies are really interesting in my point of view. And instead of analyzing dividend stocks, the website is dividend stocks cash, dividend stocks to get some cash, I will analyze some tech stocks right now. And the first one is the trade desk, because I believe there are some tech stocks with solid business models, and after the correction, after this partly really heavy capital losses, some of these stocks are really interesting. And let's start with the trade desk. By the way, we have our Black Friday deal, so you get dividend stocks cash right now a little bit cheaper, and I will show you now that you can not only analyze dividend stocks with this, but for example tech stocks as well. And the first one is the trade desk. Business model of the trade desk is to help you in a heavily fragmented advertising market, because there are so many channels you can put your advertisement on that it's a little bit confusing, especially if you don't have a big agency or a lot of specialist employees employed who do nothing else but advertisement. So basically, you have a budget and you give the budget to the trade desk, or you use the trade desk or software platform, and they make the different channels more transparent, help you by booking, and they help you by verifying or controlling how it worked. So your return on your invest in advertisement, and this is really helpful. And the trade desk, of course, gets a little provision, between 5 and 20%, and you will see that the margins are really high, by the way. First, let's have a look at the performance if you invested into the stock. And from the very beginning, you had annual yield after correction of more than 50%, everything capital gains, no dividends. But you also see that within the last 3 years, we have a lot of volatility and no capital gains anymore. And now it's the question if maybe the time to buy is, or if it is a good investment from today's stock price. But let's first check a little bit the fundamentals. And we see here nicely growing earnings. This is adjusted earnings. Reported earnings look like that, the green in green color, and you see a huge difference. Difference between this is because of stock-based compensations for the employees. Is this a problem? In my point of view, not so much, because first we see here the operating cash flow, and the operating cash flow is very close to the adjusted earnings, because the stock-based compensations are not cash flow positive or negative. So there's not really money going out by this. It's not a remuneration by cash. So this is why operating cash flow and adjusted earnings are very close to each other. So this is okay. And you can also see here that the number of additional stocks given to the employees is not that much that we have a considerable dilution of the per share matrix. So it's very small indeed. And here, this is the most important parts of the balance sheet. And you see here the incredibly strong balance sheet is a Apple-like or Microsoft-like balance sheet. We have here first the so here we have the liquidity, cash and so on of the company. This is the inner bar, which is 1.5 billion US dollar. And then we have here interest-bearing debt of less than 250 million US dollar. So they are completely debt-free. And what's also nice is looking at the amortization power, which corresponds to the free cash flow, 1-to-1, because they don't pay dividends, as I said. And here you say that they have a free cash flow double as high in 1 year than interest-bearing debt. So this is rock solid balance sheet. The numbers are less high in absolute numbers in Apple, but if you just look at the balance sheet in relative comparison, it's really great and on par with Apple, I guess. What's not so good is if your revenues are okay, but if you look at margins, and first you see that the gross margin is more than okay, super high, more than 80%. This is as high as only software companies can achieve. But if we have a look at the operating margin, you see that the operating margin declines. In 2020, it was still 70%, and now it's about half only 8%. And this could be worrisome. Why is it so? And the reason is given here in the profit and loss statement. If you compare 2020, the operating expense is 575 million US dollar. Yes, operating income. Gross income minus operating expenses. Operating income. And here you see in the tooltip the operating margin of 17%. I just showed you. Okay, operating expense 575 million US dollar in 2020. 2 years forward, 575 became 1.3, close to 1.3, or more than doubled. And this is why the operating income is so low and the operating margin is so low due to higher costs in general administrative or marketing and research and development, or IT stuff. And why this explosion of costs? Because the trade desk wants to go international. Right now, as an American-based company, most of their revenues are done in the United States, but they want to expand to Europe and to Asia, focusing on China, India, Indonesia, in Asia. And this costs a lot of money. So these are future investments. I think, I don't know, of course it's a risk. The operating margin would be much higher if they did not want to expand, but I think this is the right thing to do if you have a working business model. And basically, advertisement is global, not only in the United States, and their customers are global too, or many of their customers are global too, so expansion is just the logical next step. So now it's time to look at the valuation, and we have here the multiples. And if you look at the multiples based on adjusted earnings, you see that we had here some multiples in 2020, hype time of more than 100, 120, 30 even, some then again more than 100 end of 21. Now we already had within the correction price earnings of just 35, but now it's about 50, close to the average. And if you look at the fair value, then we make this, we use the adjusted earnings per share to calculate the fair value. And here it comes. This is a fair value. Let's zoom in a little bit. Get rid of this. And here we see one more time, very impressive, the hype phase. And now we are close to the fair value. We have growth rates of about 20% plus to expect. In the current year, a little bit, next business year, a little bit less. This will be the phase of expansion. This is my interpretation. And then when all these additional costs for expansion are gone and the expansion generates revenues, and revenue growth should expand again. So based on the historic average multiple of 50, which is still a lot, I agree, we have here expected yield of 14%. 14% is not that much if you compare it to what you got with 50% if you invested from the first day. But I think, for me, the trade desk is an interesting stock, but I would buy it not immediately right now, at least not one time, but I would set price limits. You can do it here. You can set a buy limit. You can set a buy limit here. And buy limit would be, for example, go to 60, 55, and 50 US dollars. Anytime you go lower, the expected annual yield goes up. By the way, I do not take this fair value because it's very maybe too optimistic, I just go to here, where the fair value is 88 US dollar. It was already much higher than 88 US dollar in 2020. And then you have already 19% annual yield. And if you go from 60 to 55, then 90 becomes 25%. And if you go to 50, your expected annual yield grows to 30%. So you need to be aware that the trade desk is still not, it is not a cheap stock in no way. And this is why we live in uncertain times. I think it's a promising strategy if you consider buying this stock, investing into this stock, to set buy limits as I told you. So that was the trade desk. I also have other tech stocks and in my pipeline to analyze. I hope you like this, so that we are not only showing or analyzing dividend stocks. Dividend stocks are cool, but one or the other tech stock as well. I think it's a nice change. Okay, thanks for watching and see you next video. And if you want so, drop me a comment below what tech stocks I should analyze. I'm not thinking about Microsoft, Apple, Alphabet and Meta, but about such hyped tech stocks, which went up after the Corona crash and which came down during the correction in recent times. Okay, that's it. Bye-bye.